Well, to take a deeper look on what's moving markets, I want to bring in Kevin Mon, President and Chief Investment Officer of Hennian and Walsh Asset Management. Kevin, great to have you on the show today.
Thanks for having me back.
Especially as a lot of these tech earnings kick into high gear starting this afternoon. I know you follow the tech space closely. What's the expectation from the results this week?
Yeah, it's a really big earnings week for big tech, and those earnings are likely going to have a significant impact on the psyche of the markets overall. Kristen, as much as the rally has expanded beyond just those magnificent 7 technology stocks that accounted for 62% of the total return of the stock market last year, earnings growth hasn't expanded beyond those technology companies, and that's likely to carry through this first quarter earnings season. FactSet estimates that earnings growth year over year for the technology sector will be at 20%. Communication services are expected to grow 20% year over year. Yet the rest of the S&P 500 is only expected to grow about 0.5%. So we really need that breadth of the earnings rally to take place to see future gains in the stock market. Hopefully these big tech companies that start us off will start us off at the bang.
I was going to say, and they do, we know, as you pointed out, have an outsized impact because of their size. And so we've seen the S&P fall, almost 5%. The NASDAQ probably down a little bit more than 5% from its recent high. Do you think these tech results can prevent the overall market from hitting correction territory, which would be a 10% drop?
They can, but I don't know if they will. Remember, the big juggernaut, Nvidia, doesn't report till May. So we have to rely upon Apple, we have to rely upon Tesla, Microsoft, and the like to provide that earnings boost. And we may not necessarily get it from them. We also have the concern over what the Fed will do or not do. We came into this year with many market participants believing they might decut rates by 6, 7 times. Now some people are forecasting they may not cut at all. That uncertainty leaves a lot of unrest in the market, and all those gains that you spoke about earlier, Kristen, were predicated on the belief that the Fed was going to start cutting rates this year and they'd be able to navigate a soft landing.
You know, of all the factors that we talk about, it still does seem as if the Fed is in the driving seat for the path forward for the overall market.
They always are, but earnings do matter,
and
this is a very critical earnings season, especially for big tech.
Okay, before we talk more about the Fed, which does meet next week, I do want to talk more about technology. We have the earnings, as you mentioned. We'll wait on Nvidia, again, one of the most valuable companies there, Nvidia, that is part of the Magnificent Seven. But what's the opportunity that you see in technology as a whole, especially the semiconductor space, as AI hype, if you will, with ChatGPT debuting about 18 months ago, has driven a lot of the tech rally of late?
Nvidia has certainly been the poster child of the AI boom. And I would argue that artificial intelligence overall has been the tail wagging the stock market dog thus far in 2024. But Nvidia isn't the only opportunity within the AI ecosystem, nor are semiconductor chips the only area to invest if you're looking for AI growth opportunities. I define it as being 4 different segments within those ecosystem, which when they operate cohesively together, allows this transformative technology to move forward. And that's why we came out with our transformative technology trust, that Smart Trust, earlier this month, to invest in those 4 areas. Software, which we consider to be the brain of the application, developing all those sophisticated models and algorithms. But those algorithms can't work without the semiconductors and the chips. But to make all that AI work in the real world, you need hardware. And finally, what's the nervous system behind all of that? It's the data centers. And the data centers we generally find within the REIT asset class or the REIT sub-security type. So it's a different way to approach it, a more diversified way, but I think it's a good path forward for those investors looking for a diversified opportunity for AI opportunities.
Do you think we're in the early innings? At what stage are we in the potential for artificial intelligence, especially when it comes to investments?
Yes, and I love sports analogies. So I've been asked this question a number of times. What inning are we within the AI boom? I would suggest we're only in batting practice of the AI doubleheader. Look to the last quarter earnings call. 36% of all S&P 500 companies referenced or made specific comments around AI, the most ever. We saw Microsoft announce that they're investing over $2 billion to build data centers in Japan by the end of next year. We saw Digital Realty announce that they're in a joint venture right now with Blackstone to build over $7 billion worth of data centers across the world in areas such as Paris, Frankfurt, and even the northern parts of Virginia. We're just at the beginning stages of the AI boom, but there's likely to be many potholes along the way.
So how does AI translate into our everyday lives, right? I mean, people might be scared of AI. Why would I invest in it if it's going to take my job and take power away from me? What would you tell them?
Yeah, obviously there's good uses for AI and there's nefarious uses for AI. One example I always like to give on the nefarious uses is cyber attacks. Unfortunately, companies are using AI to increase the likelihood and the success rate of cyber attacks. But then you have a company such as CrowdStrike, which is also using AI to help thwart those AI-powered cyber attacks. Ingenious, right? How about healthcare? AI will provide the ability not only for drug discovery, but also disease identification. Fascinating. But for all that happen, we need to store the data, process the data, and put it to real-world use. And I think if you look at those types of opportunities within the AI ecosystem, the software, the hardware, the chips, and the data centers, that creates the whole picture.
Certainly technology is more volatile, has a higher beta than the overall stock market, but we have seen it lead a lot of the gains, as I mentioned, these past 18 months or so. What's it going to take for this rally to broaden out? These poor small caps, I see up there on the big board, still underperforming today.
Yes.
And they've had a hard time, but I think some people have been optimistic that it might be a buying opportunity.
I think it is, but we really do need to wait to see what the Fed ultimately does. As we learned on March 20th, they reaffirmed their outlook for 3 interest rate cuts this year. Although they did up their forecast for inflation at 2.6% this year, and reminded all of us that they don't see inflation coming back to their 2% target until the end of 2026. Yet they're forecasting interest rate cuts all the way through that time period. So that tells me that they're more concerned with the potential recession than they are with inflation staying above 2%. But the market needs to see action from the Fed. If that first rate cut doesn't take place until after the presidential election, I think the market will become very weary and probably give back even more of the gains that we've seen thus far this year. If we get that first rate cut, perhaps at the end of July, I think that gives the market some comfort, and then you're going to see the rest of the market start to come along with the Magnificent Seven.
Interesting. How are you thinking as an investor about the election and what it could mean for the path forward for stocks?
Yeah, I don't know who's going to win. But I do believe that we're going to have a divided government coming out of this particular election with respect to the House of Representatives and the Senate. And historically, that's been good for the stock market because new legislation has that much more of a difficult time being passed. So I think we'll find ourselves in that scenario again. Obviously, there's different areas of the market that could benefit from one party being in office versus another. But overall, and I'll remind all investors of this, there have been 23 elections going all the way back to the end of the 1920s. And in 19 of those, the stock market was higher during those presidential election years by an average of nearly 12%. So don't sit on the sidelines because you're nervous about what could potentially happen in the election. Don't try and time the market because that's often an exercise in futility, right? Position yourselves consistent with your risk tolerance, with your growth or income objectives, and your overall investment time frame.
What do you think is an appropriate risk tolerance in this environment?
It's really up to the individual investors. I can't dictate what anybody's risk tolerance is. But if daily moves in the stock market make you lose sleep at night, perhaps you shouldn't be in the stock market. If you're concerned about the ebbs and flow of what the Fed may or may not do, maybe you take down a more balanced position. We always hear about the 60-40 strategy, right? It fell out of favor in 2022. Now it's coming back into favor. And I think it will be even more in favor once the Fed does start cutting interest rates, as both stocks and bonds should move higher.
Bitcoin, is that on your radar?
It is not on my radar whatsoever. But I still like the underlying technology of blockchain. It's another type of disruptive technology that we continue to look at.
It's been interesting to follow Bitcoin.
It's interesting, all right.
And what it means, yeah, about risk. Kevin Mon, President and Chief Investment Officer at Hennian and Walsh Asset Management. Kevin, thanks so much for joining.
My pleasure. Thank you.
Great to have you.